Silver has two prices right now. One of them doesn't matter anymore. On screens, silver looks liquid, tradable, alive. Numbers move, charts flicker, but the price you see isn't the price you pay, and it definitely isn't the price you get when you try to leave. Market participants now describe the world spot price as a futures construct where nearly 400 paper ounces trade for every single physical ounce produced. That ratio alone tells you the number is no longer anchored to reality. Here's the contradiction. The system insists silver is abundant. The physical market behaves like it's disappearing. And if you're saving, hedging, or planning to convert paper into something real, that contradiction lands directly on you. Because when pricing stops reflecting supply, risk doesn't disappear. It relocates quietly onto the last person holding trust. But here's the part nobody explains clearly. If the price isn't real, then the market isn't just volatile. It's fractured. And once a market splits, it never reconnects cleanly. What you're seeing now is the early stage of that split. It starts with what looks like normal trading. Silver spot prices derived from futures contracts, not from physical settlement. Most contracts never result in delivery. They net out on paper. Price discovery happens in a space where the underlying metal rarely changes hands. That worked when paper and physical flowed together. It doesn't work when they don't. Dealers and wholesalers report a two-tier market. Paper says one number, physical trades at another, padded by premiums and scarcity. Sovereign coins like American silver eagles are constrained even as screens suggest abundance. Now notice what's missing. There's no panic headline, no official admission, no bell ringing. Instead, dealers quietly ignore spot just to stay alive. This isn't a blip, it's a pattern where the quoted price becomes an abstraction and the real price is whatever convinces a holder to part with metal they don't expect to replace. And that raises a dangerous question. If paper trading sets the price, but physical trading sets availability, which one actually governs the market? Here's where the first hard proof lands. Wholesalers report that refineries are refusing to process anything except 0.999 fine silver. Alloyed silver, including 90% constitutional silver and sterling, is being rejected. Wholesalers are getting buried in metal they can't move downstream. That's not sentiment, that's logistics. Refineries prefer 0.999 because it can be quickly assayed and converted into COMEX deliverable bars or industrial feedstock. Alloyed silver requires chemical separation, more steps, more inputs, more risk. When refineries stop buying scrap, liquidity doesn't just slow, it evaporates. Now notice what they didn't deny. The silver still has value. It just has no clearing mechanism. This is what a liquidity trap looks like in the real world. Assets that technically matter but can't be turned back into cash at scale. Dealers cap prices or stop buying altogether, not because demand is gone but because the exit is blocked. And this is where the story escalates, because the refinery refusal isn't ideological, it's chemical. Refineries cite a shortage of nitric acid, the chemical required to dissolve copper out of alloyed silver. Without it, refining 90% silver becomes uneconomical or impossible. Now watch how fast this escalates. That same nitric acid is being consumed by the defense industrial base. Missile production requires large quantities of nitric acid and extremely high purity silver, 4 nines or 5 nines, for guidance systems and electrical reliability. Civilian refining is losing a zero-sum competition. Military production has priority, it has purchasing power, it consumes both the chemical inputs and the refined silver itself. And unlike silver in jewelry or photography, silver used in missiles doesn't come back. It's destroyed, lost, or scattered permanently. This isn't a demand spike, it's a structural drain. Historically, silver demand came from places where recycling closed the loop. Photography faded and silver returned. Electronics reused. Jewelry stayed above ground. This is different. Strategic consumption removes silver from the global stock forever. Normalization matters here. It is not normal for refining capacity to freeze. It is not normal for scrap markets to break. But it's happening quietly without headlines while the paper price keeps printing reassurance. That's the normalization of dysfunction. And wholesalers see it coming. Wholesalers are capping their buy prices despite rising spot prices. They refuse to pay up even as the screen says silver is worth more. This isn't generosity, it's fear. Wholesalers expect a paper market correction or suppression. They're protecting their balance sheets from a futures-driven price smash that would leave them underwater. So they cap, they ration liquidity, they shift risk downward. Here's why that detail changes everything. Even if the spot price rises, your ability to sell back into the system is being quietly throttled. The spread widens, buying feels expensive, selling feels punitive. This isn't a free market, it's a gated one. And while that's happening, sovereign supply starts to wobble. Major distributors report American Silver Eagles on backorder, with monster boxes unavailable and delivery dates undefined. Dealers are redirecting customers to alternatives because the flagship product can't be sourced. This isn't a weekend outage. It predates convenient excuses like shutdowns. Production continuity at the sovereign mint level is unreliable. When a state-issued coin disappears, it signals more than demand. It signals a breakdown in trust infrastructure. Private mints can fill some gaps, but prestige matters. Confidence matters. The absence of eagles is a leading indicator. It tells you the retail distribution network is strained at its core. Now stack the pressures. Refineries clogged, chemicals diverted, wholesalers defensive, sovereign supply erratic. What happens if this continues? The impact stops being abstract and starts hitting you. Buyers increasingly cite mistrust of banks as their reason for entering the physical metals market. Cash withdrawals require appointments, accounts get frozen, access is rationed, banks are managing liquidity stress by controlling behavior. When you can't freely access your own money, trust breaks. People respond by exiting custodial systems. Physical metals offer one thing banks can't: no counterparty. This isn't fringe behavior. Even military personnel advise peers to pull funds out of banks. The push isn't political, it's practical. If this feels familiar, say so in the comments, because once trust erodes, it doesn't return easily. And that shift activates an old rule. As fiat currencies debase, populations hoard real assets. This pattern appears repeatedly in history. Copper leaves pennies. Nickels face elimination. Coinage becomes unprofitable to produce. Gresham's law is reasserting itself. Bad money circulates. Good money disappears into private hands. Silver is being remonetized in the shadows. Not officially, practically. People trade labor, goods, and security for metal because it doesn't rely on promises. The expectation isn't quick profit. It's survival through instability. And this isn't limited to one demographic. The buyer base now includes younger people, women, liberals, conservatives, service workers, regular people. Distrust has gone mainstream. That matters because physical silver is finite. New buyers don't replace old ones. They stack on top. And many of these buyers aren't planning to sell, they're preparing. Motivations have shifted from wealth enhancement to preparedness. Buyers openly reference riots, anarchy, prolonged downturns. Silver is framed as barter insurance. Sticky inventory changes market dynamics. When holders refuse to sell at any fiat price, liquidity dries up regardless of spot, which leads to a paradox. If silver prices explode in dollar terms, it likely reflects dollar collapse, not silver windfall. Nominal gains mask real loss. Selling silver for fiat, in that scenario, defeats the hedge. At the same time, a physical liquidity trap emerges. Once you sell, re-entry may be impossible. Supply won't be there. That's why behavior is shifting toward divisibility. Demand for fractional silver is exploding. 10th-ounce units sell in massive volumes. They're preferred over 90% coins because weight and purity are explicit. In a stressed environment, trust is speed. No explanations, no math. Marked silver trades faster. This prepares for a world where electronic payment systems fail intermittently, not permanently, where velocity matters, and that future collides with an educational gap. Many younger heirs lack understanding of real money. They trust digital abstractions. Some stacks may be liquidated poorly or lost entirely. Knowledge transfer is as critical as metal accumulation. Finally, zoom out. Government debt trajectories require ongoing currency expansion. Obligations can't be met without debasement. The math is unforgiving. Inflation is not policy. It's inevitability. The futures market delays recognition. The physical market doesn't. That's the different game now being played. Paper reassures. Physical signals stress. The deepest insight here is simple. Markets don't break all at once. They split quietly, and the side tied to reality moves first. If you want to understand where this goes next, follow the signals that don't need belief, only logistics. Subscribe for continued analysis. The next move is already forming.